One of the many benefits of being a Motz Wealth Management client is the opportunity to meet and speak with industry specialists and professionals. Our speaker for the 2014 Halftime Report is Melissa Motz, President of Motz Wealth Management. She has over 25 years experience in the tax and financial industry, is a CFP, CPA, and has a master's in taxation. This presentation was recorded on July 30th, 2014. All right. I guess it's about 7:30 and everybody's here for our presentation today. So thank you so much for coming. I appreciate it. Being in here with on such an absolutely gorgeous evening out there. Gosh, this is September weather, I'm telling you. It's beautiful. So this is our halftime report. And our next event, we're going to have an open house at our new office space on Wednesday, September 24th from 5 to 7. So you'll get information on that. And we'll have beverages and hors d'oeuvres, and everybody can tour the new office. So keep a lookout for that. So these are the pictures of in construction, what it looked like. It was just an open cement floor and just a giant area with stuff hanging out of the ceiling. And so then, of course, they had to put the walls up first, and then we moved in on July 5th. Movers came. Everything went so smoothly. I mean, it was really a help that Jen and Pam had all the boxes labeled and the rooms with, labeled as to what number was what room, and the boxes went into those rooms. It just went so smoothly. So it was wonderful. Okay, there's the outside. You've all seen that. Quite a difference from our old office. Yeah, it's really great. So we're still settling in, still have some furniture to get put in and things up on the walls, but it's really lovely to be there. We're just all so grateful. Also, I want to let you all know, if you're interested in introducing us to someone that you know, they couldn't make it to one of our events, I'm free for a lunch or dinner, personally to get together with them in a nice social, low-key environment. So please keep that in mind, because sometimes this doesn't work for everybody's schedule. All right, so I'm just going to go over a couple fun words we learned this year. Or interesting words, I guess, maybe not fun. Polar vortex. Didn't we all learn what that was this year? Yeah. I hope I never hear of a polar vortex again, I have to say. So, of course, we know it was the third one, a blast of brutally cold air. Came down from the Arctic into the United States. There it is. Remember those pictures, seeing them on the TV? Yeah, it was quite a winter. But at least our summer's been pretty nice, so. ISIS. So that's abbreviation for ICIC under messaging, or a Star Wars movie, or the Islamic State in Iraq and Syria. The third one. Yeah, so I'm going to skip over this next picture pretty quickly. So that's ISIS. New Nikes. What is gamification? Has anybody heard of that word? So these are words you can go back and tell your kids, you learned while you're here. So a complex scientific procedure where particles are broken down to form new elements, or new techniques used at beauty parlors to enhance a person's attractiveness. Or a concept that is spreading like wildfire, where educators and companies apply game design thinking to non-game applications to make learning and advertising more fun and engaging. That's it. Yeah, that's it. So I like the old way. Here's the new way. Turn your mobile phones on. All right, so it's just some fun new words. I'm just going to go over a few things, just a general economic update, and just put some things in perspective here. So we have this first slide, looks at the S&P 500 index from 1997 up through 2014. And what a lot of people are concerned about when they look at just this is, here we went up to the high, and the tech bubble happened in 2000, and then we had a long, 2.5, almost 3-year bear market, with the market coming down quite a bit. And then we slogged our way back up to October 9th of 2007, the high, and then in a very short period of time, March of 2009, hit our low. And then we've slogged back up, and now we've surpassed that last high. So you can look at that and think, oh, well, we're due to go down. Okay, it's going to correct. All right. Keep that in mind. Just keep in mind that I'm going to show a few slides out of an even longer term time frame, to kind of put this in perspective. Just because we've passed the highs where we were doesn't mean we have to come back down again. Okay, it doesn't mean that. So just keep that in mind. All right, what this slide shows, with all these dots all over the place here, is at the bottom we've got interest rates for 10-year treasuries. Okay, between 0 and 5%, we see this little red line, dotted line here, and then above 5%. And what I want to draw your attention to is the fact that yields right now on 10-year treasuries are about 2.5%. Okay, so they're about right in the middle here of this line. And what this is showing up here is when yields are below 5%, which is where we are, rising interest rates generally are associated with rising stock prices. And this is looking at, over time, over many years, what happens during rising rates when rates are in this time frame. Okay, when they go out and rates are higher, rising rates are associated, it's the opposite, stock prices go down. Okay, so we're in this time frame right here. And a lot of that has to do with what other investments are available. We talked about money market rates, so we'll look at that a little bit. We talk about bonds are really low. So, people are wondering, well, why do stocks keep going up? Because earnings keep going up for companies. This just shows for corporations, their cash as a percentage of their current assets. And you can see how it's high. Okay, it's very high. Here you can see the amount of cash that's being returned to shareholders. Every day we're hearing about companies buying back shares, they're increasing dividends, mergers and acquisitions. There's a lot of cash, and companies need to find ways to, just like we're trying to find ways to get a yield on our money, companies are trying to do the same thing because they have a responsibility to stockholders, to make money on the money. They can't leave it sitting in cash earning 0.09%. That just is not going to fly. I like this slide because this puts some things in perspective too. These red dots are showing an intra-year decline. So in all these years, you can see where the market, the S&P 500 was down, but there are many, many years that ended up. So even though there's an average intra-year, within the year drop of 14.4%, annual returns are positive 26 out of 34 years. So it's just another thing to keep in mind, to keep a longer term perspective. You're going to have volatility within a year. But generally, it works out that, it comes back and closes up. So if you remember the first slide that I showed you from 97 till now, we had the high, down, and then here we are beyond it. This stretches it out over a much longer time period. So that time period was like right here, from here to here. So what this is showing you is we have these long periods where we don't really get anywhere. And then we have, well, this was the 20s, and then that was the crash. And then we have periods where we get somewhere. We break out, and the economy expands, companies do well, stock prices increase. And then we have time periods where we don't get anywhere. And then we have, so the big question is, where are we right now? Are we going to take another dive, or are we positioned pretty well? Personally, I think we're positioned pretty well. I think we're going to have, a number of years of some nice returns in the stock market. I think we're into a new secular long-term trend because interest rates are so low, because companies are so profitable, inflation is low. I mean, there's so many good things happening if you don't listen to the political landscape. So. And even there, when they can't decide and they can't do anything, that's actually positive as well, because it means that status quo is just going to happen. This I just wanted to show briefly. These are having to do with this top slide right here. These are debt payments as a percentage of your personal income. So that means out of the total money that you're earning, what percentage of that are you making for monthly payments on your debt? And look at how low it is. Look how low it is. It's lower than it was in 1980. So, I mean, that's a good thing. That's a really good thing. Residential real estate. Again, average mortgage payment as a percentage of household income. Right here, this top slide right here. Down lower than 1975. I mean, think about it. You remember when you got your first mortgage and what rates were then? You know, how many times have you refinanced over the years, right? As rates have come down and down and down and down. So, that's a good thing. And then commercial real estate, I wanted to point out the vacancy rates for apartments, 4.2%, very low. So we're needing some housing. Otherwise, rents are going to keep going up. Rents are going to increase. And then the federal finances, we can't kind of get through this without looking at the government. But one of the things I wanted to point out was over here in this graph in the top corner, this is the federal budget deficit. Okay, these are the surplus. We had a few surplus years here at the end of Clinton into the very beginning of George W. Bush's presidency. And then we were deficit spending again every year. And then we had 2009, 10, 11, we had, after the financial crisis, we were pumping money into the economy. But you can see our annual deficits are coming down. They're coming down. And down here, this shows your accumulated debt. So it would be like, if you're spending more than you earn year after year after year after year, you're accumulating this debt, like it's piling up. And the talk a couple of years ago was it's just going to get so high and, things are going to crash and we won't be able to, but it's leveling off. It's leveling off. They don't need to keep increasing it. They don't need to do it. Our economy's recovering. So they don't have to keep, deficit spending. Just as, as we sing, our deficit every year is coming down and our economy is growing. And employment rate. So we lost 8.8 million jobs during the financial crisis, and we've recovered 9.4 million jobs. Now, that doesn't account for people that have entered the workforce, but that also doesn't account for a lot of people who have left the workforce in that time frame. As we have the baby boomers, there's several of them in this room that have retired. So, there are a lot of good things happening there. Oh, this just shows where the jobs are being created. So government's losing jobs, and then this shows where jobs are coming from. Information, financial and business services, manufacturing. They're the two leading providers of jobs. And we are seeing, companies are coming back into the U.S. for manufacturing. We've got our energy renaissance going on, which I think personally is going to be really good for us over the next many years. As far as economy, environmentally, that's a different, that's different. And then this also I think is interesting. Less than a high school degree, still pretty high unemployment there. I mean, they were really crushed, during the financial crisis. But a college degree, still the unemployment rate for someone with a bachelor's degree is 3.2%. It's not bad. And the amount of money that you earn with an advanced degree or bachelor's degree is very substantial. So it still pays, to get an education for sure. And the consumer price index, this just shows you, people say, how can inflation, they say inflation is really low, but yet I go here and prices are going up and so forth. So just to give you an idea of what makes up the consumer price index and then what the change is over the 12 months. And the core, they call it core CPI. That does not include energy or food, even though we all need energy and we all need food. Yeah. And this I just wanted to point out here because the Fed, who just spoke today, they had a meeting today, they're forecasting that the Fed funds rate, which at the end of this year will still be at 0.25%, 0.25%. Next year, they're estimating it'll be over 1%. So that's a pretty big jump. And then at the end of 2016, it's going to be higher. And the long run, it's expected to go up closer to what it was historically, to 3.75%. So we will see, interest rates going up in the future. And then this also is interesting. This part of the slide shows who's buying our debt, the U.S. debt. So our own Federal Reserve is buying a big chunk of it. We can see foreign private, so that's foreign individuals, foreign official, the governments, households, pensions, a tiny little block, mutual funds, a tiny little block. Okay, so that was for the year ended at the end of the first quarter of this year, 2014. But when we look at it, who holds them? We look at, over all the, not just the ones that have been issued in the last year, but who holds it? The Federal Reserve only has 18%. The bulk of it's still held by foreign governments of our debt and foreign private. You can see our households hold 7%, foreign private holds 15%. So, we are still like the most stable, lowest risk, debt to invest in our government, the United States. So it's very attractive. And this is my last slide. So this shows the annual income generated by a $100,000 investment in a 6-month CD. So back in 2006, it would have been $5,240 and $390 now for $100,000. So I know people come to me and say, I'll need this money in so many months. Where can I put it, that I can earn something? And it's, you have to take a risk to do that. And so we're just kind of stuck with these low rates for now. But as the government, if they do raise interest rates, as we're talking about, we should see these start to go up. Yes, that was everything I had. Any questions? No? Okay. All right, good. Well, thank you everyone for coming. I appreciate it. And if you have any questions that you want to talk to me on the side about, just let me know or give me a call. All right, thank you. I hope you enjoyed listening to Melissa Motz, and if you have a friend or relative who is considering their financial options, please feel free to invite them to accompany you to one of our upcoming events. Visit our website at www.motz, that's M-O-T-Z, wealthmanagement.com for the most up-to-date listing of these events. Over the years, many of my clients have asked me to speak with a friend, relative, or colleague concerning private financial management. I consider it an honor and a privilege, and have been happy to accommodate those wishes. For your future reference, I want you to be aware of the standards by which I comply with such requests. First, confidentiality is the cornerstone of my business. Each of my client relationships is distinctly separate and totally private. Second, thoughtful and courteous service is guaranteed. This is a people business. Finally, I will never give advice and counsel to a client without thoroughly understanding his or her needs. Please contact us at 215-513-6240 or send me an email at melissa@motzwealthmanagement.com. Melissa H. Motz is a registered representative, securities offered through Cambridge Investment Research, Inc., a broker-dealer, MEMBRA, FINRA, SIPC. Melissa H. Motz is an investment advisor representative, Cambridge Investment Research Advisors, Inc., a registered investment advisor. Motz Wealth Management and Cambridge are not affiliated.